All right, welcome to this explainer. Today, we're diving into a really fascinating, kind of counterintuitive decision in global finance. Why do massive, highly successful companies look at a stock market listing, see all that potential capital, and just say, no thanks? Let's explore exactly why these sovereign boards choose to stay safely behind closed doors. Picture this. You've built this incredibly successful billion-dollar business. Suddenly, investment bankers are practically knocking down your door, offering you a fast track to enormous permanent capital. But what makes a board look at all that cash and turn it down? Why stay a private limited company instead of cashing in? Seriously, would you turn down billions of dollars? So, Section 1, the family pizzeria versus the global franchise. Let's break this down with a simple metaphor. Think of your private company like a local, family-owned pizzeria, right? It's your kitchen, your rules. You pick the secret sauce, you choose the music, and you only answer to a few trusted partners. But going public, that's like turning that local spot into a huge global franchise. All of a sudden, every single shareholder wants a vote on your ingredients. You've got to broadcast your recipes to the world every quarter. Thousands of people suddenly have an opinion on exactly how you should run your kitchen. And, well, it all really boils down to one word: control. To run a private company, you literally only need a minimum of 2 shareholders, just 2. That lets a couple of founders hold the reins super tight, totally insulating the board from the noise of thousands of outside voices trying to steer the ship. Now, obviously, issuing equity shares to the public is a hugely popular way to raise permanent capital, but you just can't ignore the math here. Issuing equity fundamentally means giving away ownership. And for a lot of founders and boards, that loss of control simply isn't a trade-off they're willing to make. They don't want the dilution. They want to chart their own course, without having to manage the whims of a sprawling public shareholder base. Moving on to Section 2, the burden of regulation. So when a company decides to list on a major exchange, think the London Stock Exchange or the NYSE, they have to produce something called a prospectus. Now, let me be clear, this is not just some glossy marketing brochure. It is a massive, meticulously factual legal document. You have to lay bare your director profiles, your past trading history, and, this is a big one, you have to absolutely avoid any misleading projections. It's a monumental, frankly exhausting undertaking for any organization. And honestly, the pressure doesn't just magically disappear once that prospectus is out the door. Once you're public, your back office is suddenly managing this incredibly complex web of ongoing regulatory reporting, and it's totally non-negotiable. If you slip up and fail to meet these rigorous standards, you aren't just getting a slap on the wrist. Your company faces heavy financial penalties and massive public censure. The regulatory burden is just immense. Which brings us to Section 3, living in a glass house. Because when you go public, the whole world gets to look inside. If an investor starts quietly buying up your company, they can't actually do it in secret forever. Look at these specific disclosure thresholds. If a holding crosses just 3% in the UK or 5% in the US, bam, identity must be disclosed. You completely lose that luxury of keeping your ownership structure private. When you're a private firm, your financial health is strictly your own business. But as a public company, your entire operational life is lived under a microscope. Every single strategic move is heavily scrutinized by financial analysts who issue buy or sell recommendations based on what they perceive your performance to be. And those recommendations can violently swing your market price literally overnight. So you're constantly stuck managing the market's perception of your value. Okay, Section 4, the IPO gamble. Actually getting to that public stage, bringing new securities to the primary market through an initial public offering, or IPO, is a seriously expensive gamble. You essentially need an army of professionals. Step 1, hire investment banks. Step 2, secure underwriters to guarantee the issue. And Step 3, perfectly time and navigate all these unpredictable shifts in market sentiment. But here's the really terrifying part for a board. What if the market just turns? If sentiment shifts suddenly right before you list, your public offering can completely fail or just have to be canceled outright. And if that happens, the company is left holding this massive administrative bill for all those investment banks and lawyers with exactly zero new capital to show for it. I mean, the operational cost and risk of an IPO are just staggering when you really look at it. Let's wrap up with Section 5, autonomy over public capital. Look, ultimately, public markets absolutely offer a massive home for your money. They are incredible engines for capital generation. But as we've seen, that capital comes with a heavy price tag. It comes burdened with strict fiduciary obligations to thousands of shareholders, plus that exhausting, never-ending weight of managing market perception day in and day out. Yet, from a purely operational standpoint, it's vital to remember that the core mission doesn't actually change. Whether your company stays a highly guarded family shop or balloons into a massive public giant, the back office reality is identical. Your books and records require total, absolute precision. The discipline is exactly the same. It's really just the audience that changes. So that brings us to the ultimate decision every highly successful private board has to face. Knowing the fundamental loss of control, knowing those staggering regulatory burdens tied to the prospectus, and knowing the intense scrutiny of living in that financial glass house, we have to ask ourselves, is tapping into public capital truly worth sacrificing your absolute autonomy? It's a billion-dollar question, isn't it? And for a lot of the world's most successful firms, the answer is a resounding no. Thanks so much for joining me on this explainer. I hope this gave you some really cool insights into the mechanics of market participation. Catch you next time.